Hi friends, in this module we will cover chapter 3 admission of a partner from question 49 to 50. Before we move on to solving the question, please note that you can download the contents that we discussed during the module by clicking on the link in the description. Also remember to subscribe to our channel. Now let's move on to question number 49. A and B were partners with capitals of rupees 15 lakh and 20 lakhs. They shared profits in the ratio of 2:3. On 1st April 2016, they admitted C as a new partner and the new profit sharing ratio will be 3:3:4. C brings rupees 2 lakh as his capital. Their assets apart from cash consist of the following: fixed assets of rupees 20 lakhs, stock rupees 15 lakhs, debtors rupees 5 lakhs. On the date, creditors were 4 lakhs and general reserve 3 lakhs. Following revaluations were made. There were few revaluations, and then goodwill of the firm is valued at rupees 4 lakhs and C brings his share of goodwill in cash. Prepare revaluation account, partners capital account and balance sheet of the new firm. Okay, let's do this. First thing is we will have to make a picture of the balance sheet. Okay, so first A and B were partners. Their profit sharing, they had capital of 15 lakh and 20 lakhs. Now their profit sharing ratio is 2:3. They admitted a new partner C, and after that the profit sharing ratio became 3:3:4. C, he is going to bring a capital of rupees 20 lakhs and he is supposed to bring his share of goodwill in cash. That is not given in the question, we need to calculate it. Okay, so first we will calculate that the goodwill of the firm is rupees 4 lakhs. So it's mentioned the goodwill of the firm is rupees 4 lakhs. So goodwill of the firm is equal to 4 lakhs. C's share of goodwill is equal to 4 lakhs into his share of profit, which is 4 plus 3 is 7, 7 plus 3 is 10, 4 by 10. So into 4 by 10. That's equal to 1,60,000. Now we calculated C's share of goodwill. We should also calculate the sacrificing ratio. Sacrifice for A, his original share is 2/5 and his new share is 3/10. So 2/5 minus 3/10, that is equal to 1/10. And B, his original share is 3/5 minus his new share is 3/10. That is equal to 3/10. So the sacrificing ratio is 1:3. This 1,60,000 that C is bringing, it has to be divided to A's capital and B's capital in 1:3 ratio. Now the question is also saying that there are few fixed assets, stock, etc. appearing in the balance sheet. So let's try to construct a balance sheet as on the date of C's admission. Okay. They say, so if you look, there is fixed assets of 20 lakhs, stock rupees 15 lakhs, debtors 5 lakhs, and creditors were 4 lakh and general reserve 3 lakhs. So let's calculate this. There is fixed assets 20 lakhs. We have stock 15 lakhs. Debtors 5 lakhs and creditors 4 lakhs. General reserve 3 lakhs, and we also have the capitals mentioned in the questions. Capitals A, B. It is 15 lakhs and 20 lakhs. 15 lakhs and 20 lakhs. So that will come to 35 lakhs. So liability side total is 42 lakhs. So obviously it's a balance sheet, so liability side should be equal to asset side. So it's 42 lakhs. But let's try to total the assets. It's 20 lakhs plus 15 lakhs. That is 35 lakhs. 35 lakhs plus 5 lakhs, it's 40 lakhs. Now the total is 42 lakhs and the items in the asset side is coming up only up to 40 lakhs. Now the balancing figure will be cash. So cash we need to derive based on the balancing figure. Cash is 2 lakhs. Okay, so now we constructed the balance sheet of the firm before admitting C as a new partner. Now the question doesn't say that we need to pass journal entries. The question says that prepare revaluation account, partners capital account and balance sheet. So we will directly go to prepare revaluation account here. Revaluation account. Debit, credit. Okay. So now there was a liability for workman compensation amounting to rupees 50,000. So a liability which will reduce the profit, it is a loss. So workman compensation liability 50,000. Rupees 20,000 of debtors are bad and provision of 5% was to be created for doubtful debts. So there is bad debts of 20,000 and provision also has to be created. 5% on debtors is okay. First, bad debts. $20,000. Now the debtors value is 5 lakhs. Now 5 lakhs minus 20,000, which is 4,80,000. On 4,80,000 only you are supposed to calculate 5%. 5% on 4,80,000 is 24,000. So provision for doubtful debt is 24,000. Okay, next adjustment. Expenses debited to profit and loss account includes a sum of rupees 14,000 paid for AS personal expenses. Okay, this is going to increase the profit of the firm because it has to be debited to AS capital. So AS capital 14,000. Then stock includes rupees 14,000 for obsolete items. It's actually 40,000. There's a mistake in the question. So stock includes rupees 40,000 for obsolete items. So we need to put that. That means that much stock is no more useful. So we need to reduce the value of stock by 40,000. Stock 40,000. Fixed assets are to be revalued at rupees 18 lakhs. Now, currently fixed assets are 20 lakhs. Now, if the value has to be reduced to 18 lakhs, we need to decrease the fixed assets by 2 lakhs. So, on revaluation account, fixed assets (2 lakhs). Okay. Now, the total of this (3,34,000). Loss transferred to capital. 3,34,000 minus 14,000, it's 3,20,000. This has to be divided among the old partners in the old profit sharing ratio. So old profit sharing ratio is 2:3. So 3,20,000 divided in 2:3 ratio, it's 1,28,000 and 1,92,000. Now we need to prepare partners capital account. Okay, the opening balances by balance, it's 15 lakhs and 20 lakhs. Then C is bringing in capital in cash, so by bank 20 lakhs. The goodwill bought by C is distributed, which is 1,60,000 distributed in 1:3, which is the sacrificing ratio. So 1:3 ratio, it is going to be 40,000 and 1,20,000. Then the previous balance sheet is having a general reserve of 3 lakhs. This has to be distributed in the old profit sharing ratio, which is 2:3. So by general reserve, (1.2 lakhs and 1.8 lakhs. Then the revaluation account, AS capital, there is 14 lakhs and the revaluation loss transferred to A's and B's capital, 1,28,000 and 1,92,000. So we need to put to revaluation. The first revaluation is on that 14,000. The second revaluation is loss transferred. That is 1.28 lakhs and 1.92 lakhs. The total, it is 16,60,000. Here it is 23 lakhs and here it is 20 lakhs. 16,60,000, 23 lakhs and 20 lakhs. So the balance in capital account, it's 15 lakhs 18,000, 21 lakhs 8,000 and 20 lakhs. Now we need to prepare the revised balance sheet of the new firm. Okay, first is we looked at the original balance. The cash balance is 2 lakhs and the new partner is going to bring 20 lakhs capital with is also going to bring 1,60,000 of goodwill. We calculated this. So 2 lakhs plus 20 lakhs, it's 22 lakhs. 22 lakhs plus 1,60,000, 23 lakhs 60,000. So the new cash balance is 23 lakhs 60,000. Then fixed asset. It's mentioned in the question that the value of fixed assets has been reduced to 18 lakhs. Stock. There is an adjustment in stock, and after adjustment the value is 14 lakh 60,000. Debtors, it is currently 5 lakhs less bad debts, $20,000 less provisions, provision for doubtful debts, 24,000. So after reducing all this, it's going to be 4,56,000. Then on the liability side, we have creditors. There are no change to creditors. It's 4 lakhs. Then there is capital. A, B and C. So we got our capital balances here, 15 lakh 18,000, 21 lakh 8,000, 20 lakhs. Altogether it's going to be 56 lakh 26,000. Then the first adjustment says that there is a new liability for workman compensation claim amounting to 50,000. So we need to put that workman compensation claim 50,000. Now we need to total the liability and asset side of the balance sheet. So the total is 60 lakh 76,000. So we completed question number 49. Now let's move on to question number 50. X, Y, Z are equal partners with capital of rupees 1,50,000, 1,75,000, 2 lakh respectively. They agreed to admit W into equal partnership upon payment in cash of rupees 1,50,000 for 1/4 share of goodwill and rupees 1,80,000 as his capital. Both sums to remain in the business. The liability of the old firm amount to rupees 3 lakhs and the assets apart from cash consist of motors rupees 1,20,000, furniture 40,000, stock 2,65,000, debtors 3,78,000. The motors and furniture were revalued at rupees 95,000 and rupees 38,000 respectively. Draft journal entries necessary to give effect to the above arrangement and show the initial balance sheet of the new firm. Okay. So here we have three partners, X, Y and Z. Their profit sharing ratio is equal 1:1:1 ratio. And their capital balances is 1,50,000, 1,75,000 and 2 lakhs. They admitted a new partner W for 1/4 share of profit, and for this he is going to bring 1,80,000 as his capital and 1,50,000 as his share of goodwill. Now we need to construct the balance sheet of the firm before the admission of the new partner. So before the admission of the new partners, they say that there is a liability of rupees 3 lakh. Okay. Then we also know the capitals of the partnership. Capital X, Y is it 1,50,000, 1,75,000 and 2 lakhs. It's going to be 5,25,000. The total of the liability side is 8,25,000. So let's move on to the asset side. In asset side, there are few items that is mentioned, like the motors, furniture, stock, debtors. So let's put that. Motors 1,20,000, furniture 40,000, stock 2,65,000, debtors 3,78,000. So the total of assets and liabilities should be equal. So it is 8,25,000. But when we add motors plus furniture plus stock plus debtors, it's not reaching 8,25,000. So balancing figure is the cash balance. Okay. Now here it is mentioned that we need to draft the journal entries to give effect to the above arrangement and show the initial balance sheet. Okay, let's pass the journal entries. First thing is the new partner bringing in capital and goodwill, which is 1,80,000 and 1,50,000. So it's going to be bank account debit to W's capital to premium on goodwill. That is 1,80,000 and 1,50,000. Total of this is 3,30,000. So first journal entry is bringing in capital and goodwill. The goodwill bought has to be distributed to old partners in sacrificing ratio. So goodwill account debit 1,50,000 to X capital to Y's capital to is its capital. So 1,50,000, 1:1:1 ratio. It's going to be 50,000, 50,000, and 50,000. The motors and furnitures were revalued at rupees 95,000 and rupees 38,000 respectively. So there is a revaluation account here. So revaluation account debit to motors to furniture. So motors, it is 25,000, furniture, it is 2,000. So revaluation account, it's going to be 27,000. Now any balance in revaluation account has to be transferred to partner's capital account. So here revaluation has a debit balance. So X capital account debit, Y's capital account debit, Z's capital account debit to revaluation account. So 27,000 divided in 1:1 ratio, it's going to be 9,000, 9,000, 9,000. That's all for the journal entry. Now the question doesn't say that, the question says you need to pass the necessary journal entries and show the balance sheet. So the question doesn't state that we need to prepare revaluation account, we need to prepare capital account. So we can directly go for preparation of balance sheet, but in order to prepare balance sheet, we should come up with the cash balances and balances of X, Y, and Z, capital balances. So let's do that. So here, first we will find the cash or bank balance. The initial balance is 22,000. So we have 22,000. Then the new partner is bringing in capital and goodwill, which is 3,30,000. So the balance of cash and bank is 3,52,000. Then X capital account, initial balance is 1,50,000, and he is going to get 50,000 from the goodwill, and then on the revaluation there is a negative 9,000. So this is going to be 1,91,000. Y, his original balance is 1,75,000. 50,000 he is going to get from the goodwill, and from revaluation minus 9,000. So that's going to be 2,16,000. For Z, his initial balance is 2 lakhs. From goodwill he is going to get 50,000. Then on revaluation it is minus 9,000. So it's going to be 2,41,000. Now let's prepare the new balance sheet. Okay, cash balance we got, it is cash or bank, it's going to be 3,52,000. Then motors, there is an adjustment on motors, it's going to be 95,000. There is an adjustment on furniture, which is going to be 38,000. Stock, there is no change, 2,65,000. Debtors, there is no change, 3,60,000. 78,000. Liabilities, there is no change, it is 3 lakhs. There is change in the capital balances, X, Y, Z and W. So balances are given here: 1,91,000, 2,16,000, 2,41,000, and W is going to bring a capital of 1,80,000. That is 8,28,000. Adding together, the liability side total is 11,28,000, and asset side it is 11,28,000. So we completed question number 50. Friends, if you haven't subscribed to the channel, please do subscribe. See you in the next video. Thank you.